I mean, one lesson, of course, is that shareholders and bondholders in SVB have been bailed in. They have been wiped out. So that is one lesson that they will all have to take on board. And as we've been hearing, we probably are now in an era of a higher cost of capital for corporations. Therefore, that probably does raise some questions over private equity and venture cap valuations that may have been struck at, zero interest rates and therefore much more generous discount rates. And therefore, the one question we might get is, to what degree will people be looking to buy on the rally, or will they now look to start to sell on the dips? But in terms of the shareholders and bondholders, that's for the financial markets. The best news for the depositors, in some ways, we have a bit of a replay of 2008 and Washington Mutual, the biggest failure in US bank history. Again, shareholders lost out, depositors were made whole and kept whole, and that did help to restore some faith in the banking system.
Russ, I remember some of the conversations we're having here in Europe, though, and that did involve deposit holders, that effectively you needed to do your due diligence when you put money into a bank. I mean, that conversation was very much had in Europe, and here we are more than a decade on talking about moral hazard again. Clearly, there were concerns about other bank runs and concerns about money stampeding into the major lenders away from some of the regional lenders as a result of this crisis that was unfolding. Do you think now we have, I guess, a new financial system that we're dealing with, new regulation? Because effectively we've had a bank here that was a big fish in a small pond and it was too important to fail.
I think the Bank Term Funding Programme, or BTFP, the new acronym, the latest part of the alphabet soup that we've become used to over the last 15 years, is designed to try and avoid that sort of concern and provide comfort to depositors, again, by making them whole. At the same time, I think there will clearly be concerns about banks' net interest margins. Investors have been very excited about rising rates translating into high profits. Whether they now have to offer better depository rates is one question. And the other thing that a lot of investors may have forgotten is that rising interest rates in a slower economy can mean higher sour loans and higher impairment charges. So a rising interest rate environment is not an entirely straightforward one for banks, or not as straightforward as perhaps some of their recent share price performance has been suggesting. In the US, a lot of banks were trading at premium to book value, for example, whereas at least if you look at the big five in the UK, that isn't the case.